Good morning and welcome to today's webcast, The State of the Energy Industry and Valuations. Before we begin, I'm going to play a brief video.
Welcome and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I would like to turn it over to Julie Desimone, Partner and National Practice Leader of the firm's Power, Utilities, and Renewable Energy Practice. Julie?
Thank you, Amy. We appreciate everybody for showing up today and listening to our chat about the status or the state of the industry. Today we're going to be talking through both our current state. We spent quite a bit of time on the current state and what's going on right now, but then we're going to give you some of our thoughts on the future state of the energy industry. Now, as we all know, this country is in a bit of flux. We don't know exactly what's going to happen over the coming weeks and the coming months and the coming year. However, there are some pretty significant trends that will continue regardless of where things come down, both in the election cycle and at the state levels over the next year and moving forward. So we're going to talk a little bit about the oil and gas industry, the power, utilities, and renewable industry, and then we'll focus on what we see as some of the big trends that are happening in the future state. So I am Julie Desimone. I am the National Practice Leader for the Power, Utilities, and Renewable Energy Group. I've been working in the energy space for a little over 21 years. I'm pleased to have Jim Harden with me today. Jim is a partner in the energy valuation practice and leader of that group. He has more than 35 years of experience providing valuation, economic consulting, and litigation support services to both public and private companies. So Jim, you've got a wide, varied background. I'm not going to read that all for you, but we're going to first start and launch into a polling question. Amy?
Yes, so our first polling question is, what do you believe is the most significant issue currently facing the energy industry? A, presidential election. B, supply-demand imbalance caused by COVID-19. C, energy transition, or D, ESG and capital market sentiment. And I'll give you a few moments to respond. To participate, please click the button next to the answer you choose and hit submit.
And I'm going to put in a quick chat. Feel free to ask questions in the Q&A function as we go through this. We'll be trying to respond to some of them as we go through, and we've purposely left some time at the end to answer some of the Q&A.
All right, here are the results.
Perfect. I think that's kind of what we were expecting. Some all over the board, but yeah, obviously with COVID-19 and the presidential election and what that presidential election means from an energy transition stage. So moving forward, I'm going to turn it over to Jim to talk about oil and gas in current state. Jim?
Thanks, Julie. I appreciate everybody on board and online with us. And Shannon, thank you very, very much for coordinating this. Like Julie said, there's a whole lot going on now in the oil and gas business, and there isn't a whole lot of good news out there. Some news is better than others, but you know, as we all know, we're in a depression in this business. I think we're going to shoot to another polling question, kind of kick this off with. So which sector of the oil and gas industry do you think is facing the most headwinds to recovery? Everybody could answer that. We can move on. Yeah, so, you know, honestly, outside of Midstream, which is still performing, I'll say, fairly well, the yields have gone up on them. The other three sectors have all been hit very hard. When we put that question together, I know it's very, very general question, very qualitative, but it kind of gives an insight. And so maybe the participants are either in the frac sand business, DEGD, the oilfield services, or E&P companies. And, you know, the reality is that downstream companies have just been hammered as well. Crack spreads have dropped globally. Refining margins are in the tank just because of lack of demand. So if the crack spread in Gulf Coast was, you know, $15 a year ago, it's been sliced as well. So the downstream consumers of oil are feeling it too, and that's kind of been driven by the obvious destruction of demand in the space. So, you know, just kind of looking back over this past year, and I guess we're 11 and a half months in, or just 11 months in, some of the upstream deals are actually down about 60% from last year. Yeah, if you look in the right-hand side of that, 270 deals, average deal value $400 million. And the bars across the bottom on the x-axis just show the various basins, you know, the Barnett and Marcellus and Haynesville and Eagle Ford and West Texas, etc. And, you know, you see each one of them from basically 2017, 2020, so you got a 4 or 5 year look back in each one of those. And, you know, obviously West Texas, the Midland, and conventional was driving everything for quite a while. And so we just haven't, other than business combinations, there's been a real dearth of the asset level deals. The business combinations we're seeing now from, you know, ConocoPhillips bought Concho and Chevron bought Noble and so on and so forth. There's been 4 or 5 of these announced, and there's a reason for that, and it's basically cutting overhead. It's an opportunity for some companies to shore up reserves in pre-existing basins they were pre-existing in, such as ConocoPhillips already in the Permian. By Concho was basically sold at they got 36,000 at BOE, which is about a third the price of what it was selling for. Reserves were selling for a year and a half, 2 years ago. So the upstream deal market was pretty much hammered. And this map shows basically a 5-6 year look back, and the dark is where the 2020 deals are, and you see the legend in the lower right hand side. But the preponderance of the deals have been in Texas and New Mexico, and obviously earlier on there was a lot of excitement and deals being done up in the Scoop Stack and the Panhandle region as well. Upstream bankruptcy activity. This is kind of a sad slide, but so far this year there's been almost 60 million of debt flushed, and it's up over 100% from last year. 40-some bankruptcies. The map on the lower right. And this is basically from Haynes and Boone's bankruptcy monitor, the law firm Haynes and Boone. If you haven't looked at it, it's interesting to see. But the locations, obviously, most of the companies were headquartered in Texas. They may not operate there, but people today love filing bankruptcies in Court of South Texas because it's so darned efficient. Some of the bankruptcies have had a 45, 60-day turnaround, which is amazing. The other kind of takeaway on this is, when I look at the combined. And this is across the board on a lot of these bankruptcies over the past couple of years, and particularly in 2020, and the workouts on them. How much of that secured and unsecured is being written down? And, without going into specific deals, the restructured amount can be as much as 5% all the way up to 50% of the original debt. So, massive write-downs, and Alta Mesa is a good example, and you can look that one up. But had a combined market cap of $3.5 billion, and the whole thing sold for less than 300 million this year. So the write-downs are huge, which basically means the banks were just anxiously overvaluing assets. The midstream downstream deals, again, it's down from last year. A lot fewer deals, and down almost 100%. The average deal value, though, is quite a little bit bigger, and that was driven by a couple of major deals at Berkshire Hathaway, the gas and storage assets. But underlying this, I've got the circle up there, the chart that shows what kind of deals were these. Yeah, there was a couple of service station deals and I'll say refined product deals and some terminals. But a lot of these are anticipation of an active natural gas market in the U.S. And I think that's, brought on by several factors. One being, a real hot button. I was talking to a friend of mine in business last night about it. Are they going to ban flaring in Texas, natural gas flaring? And what that would do for the industry, it'd probably help him. He's in the service industry. But by the end of next year, it's anticipated there will be approximately 18 and perhaps up to 20 BCF a day of LNG send-out capacity. Almost all of that on the Gulf Coast of the U.S. And gas prices, while they're not great, Henry Hub has averaged over $3 of late, and so there's some anticipation of not just hey, it's weather related. We're pulling into the withdrawal season of gas storage. It also has to do with a little longer term outlook on gas prices, and I really think there's a lot of headroom in gas. And, I don't have a crystal ball, but it would not surprise me if next year, if we didn't see gas natural gas in the $4 range a year from now or a year from January. It's got a great upside. The U.S. obviously has the world's greatest gas infrastructure, and which will lead into some things Julie will talk about in a little bit. Oilfield service deals, again, down 60% for the year. There's 100 deals, but the deal size is so much less. And, if you've driven through West Texas or I'll say around the Denver airport, there's frac trucks, sand trucks just sitting in the pastures right now. And I think the rig count today is, let's say roughly 250, depending on how you count it. But, that's down 75% from a year ago. Well, values are down 75% too. We've seen numerous bankruptcies and liquidations from big companies all the way down to very small companies. There are some opportunists out there seizing good assets. And if somebody asks me what's the best service to be in right now, I'll say, well, it's probably water disposal. I've got a buddy that makes about $300,000 a month of EBITDA from 2 disposal wells, and he said they're in a well within 50 miles that makes that kind of money. So there have been a lot of oilfield service bankruptcies activities. Diamond Offshore up there, Noble Corp, offshore drillers, and people connected with offshore drillers. You see total debt of just those three of over almost $25 billion, and restructurings are going on all over the place, and most of that is just being driven. Brent crude today, I think it's $41. The offshore drillers have such major investments. We do a fair amount of work in that space, valuing drill ships, semi-subs, jackups all over the world, and the values on these things are very difficult because there's just such a lack of long-term contracts. For example, drill ships, 4 years ago, were fetching in the 600. Some of them are $600,000 day rates, 4 or 5 year contracts. Today, you're lucky to get a 1 year contract at $250,000 or $300,000 a day. Okay, so I want to talk a little bit about the market and some of the financial drivers. And this slide here is a little dated. I liked it though because it was so segmented, and I couldn't get a new version of it. But the top half of the chart is the industry sectors that have just been hammered by the coronavirus, the pandemic, and basically the economy. Oil and gas, E&P companies down, and this is again through mid-August, are down 25+%. And go to the bottom half of the chart, and you've got e.g. software companies. Well, software is pretty big. That would include Google and Facebook and Amazon, et cetera, and they're having stellar years. There's a big difference today when you walk the streets, if you're not scared of getting coronavirus, between Seattle and Houston downtown. The economies are just so much more vibrant today on the West Coast than they were or now in oil producing regions, places like Dallas, Houston, Fort Worth, certainly Midland, Denver. We don't have enough diversity in our economic sectors. This next slide, it's just basically the same thing. It's just okay through, and this was in late September. So IT sectors, which include the aforementioned software companies, are some of them are up at 50+% for the year, and then going on down healthcare's had a tough year. Energy, of course, we're talking about, and financial services, banking had a very tough year as well. So, Focusing in on upstream oil and gas, if you guys have heard this talk before, you probably heard me pontificate about the cost of capital. But it's really interesting when you look at there's a couple of different ways to get to the cost of capital. The most common way of calculating equity is through a capital asset pricing model. And but basically, it's just saying, okay, here's your company, or here's E&P companies. Let's compare them to the broader market, the S&P 500, for example, and look at the underlying volatility, because this beta, this difference, is basically saying, how stable are you compared to the rest of the world? Well, I haven't looked this week to see what Microsoft or Google or e.g. Alphabet or others in the tech industry, what their beta is, but I dare say it's a lot lower. And basically, the higher the beta, the more risk premium inherent when you're looking at your overall cost of capital. And you can see this year the betas are up 50% from a couple of years ago. So that's pretty interesting. And looking at the overall cost of capital, one would think that Exxon, because if you look at the graph on the right and look at the legend on the x-axis, companies greater than $5 billion, and this is again upstream companies, which would include majors that have downstream too, but integrated. But we try to peel those away and look just at the big upstream companies. And they had a much more significant cost of capital advantage 2 or 3 years ago. Right? You see, for the small companies, less than $1 billion, their cost of capital, and this is based without adding any risk premium for, where their operations are or otherwise. This is just looking and calculating it directly from their debt and their equity. They had a 25% advantage, 30% advantage over small companies. E.g., the big companies had a much lower cost of capital than the small companies. But look today, I mean, and this was done. I did this about a month or so ago. It's less than 10% difference between the big companies and the little companies on their cost of capital, weighted average cost of capital. So the credit ratings is very interesting too. So if you look on that top right graph, 2020 credit rating, companies with EVs over 5 billion, most of them are BBB rated, BBB minus. And you go down to the small companies, and most occurring is just basically their debt is treated almost as junk, CCC. Well, that's really interesting. And we think, well, oil isn't $20 anymore. We have, oil seems to have stabilized. WTI somewhere between $36, $38, $40 in that range, and people are feeling a little bit more secure and cutting costs, et cetera, et cetera. But when you look at the credit-adjusted risk-free rate across the broader, this is the total corporate yield curve, and on my computer it's a little. The bottom one is typically what we look at, a 20-year T-bill. So we go to a B-rated company, and again, this is in April 15 of 2020, so a little over 6 months ago. 9.2% for a B-rated company, right? Triple C-rated company, 20-year, was 13.5% or 13.9, I believe. Okay, let's jump ahead to 10/25. So this is a week ago, basically, and all of a sudden the B's, the yield on those is about 11.5, and the triple C, which is kind of basically junk, is 23. So even though we have seen price stability, the market as a whole does not see stability in the energy business. And, this is kind of important. I don't know of the audience. We've done 2 or 3 studies this year on asset retirement obligations, a whole other story. But this forms the basis of the credit-adjusted risk-free rate for determining what your risk-free rate is, which is how you discount back all those future costs of P&A and remediation. And there's two things going on with that. One, the economic limit, the lower oil price, is pulling those future liabilities much closer to you. That said, right, which one would think, okay, at a stable discount rate or stable credit-adjusted risk-free rate, my gosh, the cost, or I'll say the ARO has gone sky high for a lot of companies. It's actually stalled a lot of deals over this past 6-8 months. But the reality is, once you look at the quality of their I'll say company, and looking into the credit-adjusted risk-free rate, it's actually gone up. So some companies, even though their economic limit has gone way down on their properties, their and the P&A liabilities have approached much closer to T1. The issue is that the credit-adjusted risk-free rates have gone up, so getting your accountants to buy off on that's a really big deal. All right. So company ratings. This is interesting too. We saw that most common in a B plus. The big companies have better credit than the little companies. I guess that's not saying too much, is it? From a supply demand perspective, this is interesting. This is EIA, and we look at forecasts all the time. But the reality of it is, demand is seen to be relatively flat over the next few years. We are not experiencing the big growth that we saw prior, and some of that is replacement of energy source that Julie will talk about, e.g. renewables, and some of it, I don't think anybody has a good crystal ball on what the after effect is going to be on the pandemic. The U.S. has historically, I'll say the past 2-3 years, approached about 100 million barrels a day in demand of refined products. Right now, I believe the most recent estimate is somewhere around 85 million barrels for 2020, and I don't think any service says in 2021 we're going to jump right back up to 98 or 100 million barrels a day. Demand is going to maybe grow back to that, but it's going to take a couple of 3 years before we have any real visibility into what the long-term effect has been with the virus. Of this takeaway, I think the most interesting part of this, and these are just some little factoids I put in there, is the OPEC surplus in 2020. It's almost 6 million barrels a day, and I read the other day that Libya is looking at adding another million barrels a day onto the market. So I think as quickly as our reserves are depleting, and particularly the unconventional in the United States, it can be easily made up for by OPEC, at least at current thought. All right. Thank you very much. And I'm going to turn this over to Julie. If you have any questions, don't hesitate to call me or put them in the Q&A box.
Hey, Jim, there was one question that came in for you, so I'm not going to let you go quite this quickly. So a question came in the Q&A asking if you could provide some clarity on why you think there's going to be $4 gallon gas. I think that was earlier in your presentation.
Yeah. Much of that is speculation, but a lot of it also has to do with supply demand. And if we look at how much gas we're using in the U.S., and I actually did this back of the napkin 2 or 3 months ago, with the new LNG send-out, capacity that's coming on, and like I said, that could approach 18 to 20 BCF a day by the end of 21, combined with the decline of associated gas that was coming out of everywhere from the Eagle Ford, what gas could get on in West Texas and the Rockies, because there is, one, they're not drilling, so you're not going to get as much associated gas. And that's been, I've heard people, I actually looked into it about a year ago. We think that anywhere between 10 and 20% of the gas was associated gas, and nobody can really put their finger on what that exact number is. But with the decline of the wells providing that associated gas that was getting the market, in other words, these are oil wells that also made a lot of gas, that's going away. So just a simple numerator denominator says, okay, if natural gas consumption is not affected as much, where's it going to come from? And, the simple supply demand is going to say, okay, we're going to have about a 25% shortfall. So right now, and we can always say that gas is always in perfect balance because we have lots of it, right? We can measure the storage and we can measure the use across the United States. So if we have a 25% shortfall in gas production, in other words, supply side, then again, gas is $3 and we're in balance now, 25%. Is gas going to go up 25% in price? It could well, which would be $4. So that's how I back into that. Certainly not very scientifically.
Well, good. And just there was another question that came through, just to make sure the audience knows that you're talking. They were asking if it was gasoline or natural gas that you're discussing.
Talking natural gasoline.
Okay, perfect. Thank you.
Not unleaded gasoline, certainly.
Not what's going to be put into your car. Sounds good. Well, thanks for that, Jim. We're going to move next into a polling question. Amy, do you want to take this one?
Sure. Thank you, Julie. So the third polling question is, what do you believe are the most significant issues facing utilities, power producers, and renewable companies? And your options are A, regulatory environment, B, grid reliability, C, ESG, or D, natural disasters. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions.
And Amy, I was just thinking about this. We probably should have had an E, all of the above. Oh my goodness, what's next? Perfect. Well, it looks like regulatory environment is going to be facing, and I completely agree with you. I think that there's grid reliability came in a sort of close second, ESG and the natural disasters. But I think that in our space, in the power utilities, renewable energy space, there's still some continuing trends that are pretty strong in this space. The need for electricity, the need for power is not waning in this country. If anything, it's moving to much greater heights. And we'll continue to. So the need for infrastructure and a lot of dollars to solidify that infrastructure is incredibly important. So we're going to talk a little bit about where we see the current state. And this is regarding the power utilities and renewable energy deals that have been going on that we've seen. As you can see in that right box, the asset type for 2020, we're definitely seeing a trend, which I don't think this surprises anybody, into the solar and wind space. Especially as we've got, energy dependency, there's been changes in regulations, and there's been social changes that have come down the pipe over the last several years. We've seen less gas deals coming online. However, there is the question of how do we get base load? How do we make sure we've got electricity when we need it? So we still are seeing plenty of gas deals coming along. So our peer deals are averaging about 100 to 150 a year for the past 2 or 3 years, with 2020 actually up about 15% from 2019. And in the wake of COVID and just even construction issues that have gone along, that's a pretty impressive stat. Deal values continue to be all over the place. It's hard to trend those deal values, but we're seeing about $500 million for the average large deal. Wind and solar continue to pick up and are driving a lot of the recent activities. We're seeing deals that seem to be trending in the $2,000 to $4,000 per kilowatt hour with replacement costs of about $4,000 to $5,000 per kilowatt hour. What we expect to see is that trends that this installation cost will continue to get cheaper, particularly for the solar side of the industry, and they're verging on being very competitive with combined cycle gas turbines and cost. So we are seeing renewables where 10 years ago we saw, solar wind being extremely more expensive when you get into the installation costs for those units. Those are trending to be very competitive in the marketplace, which we'll talk about in just a minute. So as we move into the current state of U.S. electricity generation by fuel, we can see quite a shift or starting of a shift moving towards the renewables. So this is really showing where the oil and gas, coal, nuclear, and of course we still have that piece of our strategy that has to baseload. Most Americans expect when you flip the light switches on, or if you want cold water, you're going to be able to have it at any time that you want it. So we've got to back some of these renewables that don't have the significant or that have a significant fluctuation in time period of when the kilowatts come across the grid. We've got to back those with continuous baseload concepts. But as we move into renewables and some differences in one, battery storage, two, understanding our grid better and getting things online when our production is online, that will continue to shift towards a renewable focus in the future. So where do we see the renewable energy specifically? They continue to become more cost competitive. It's quite fun to watch a lot of what's going on out there and the new ideas that are coming along. We were just talking to, and whether or not you would say this is renewable or not, we were talking to some micro nuclear units that are potentially going to be in production over the next 10 years. Safer, more reliable, less output on that back end as far as negativity for the state of their reaction. These are the things that are coming down. There's a lot of new ideas coming down the pipe. But at the end of the day, our solar and our wind, from a renewable standpoint, tend to be our biggest future state. The interesting part is that the renewable and energy and carbon mandates continue to increase, and regardless on the change in regardless on the administration, this is happening a lot at the state level. So individual states are really continuing to ratchet up carbon mandates, which then make utilities and infrastructure look at the way that they produce energy a lot differently. We're seeing targeted micro projects being considered. We've heard of projects potentially in California due to natural disasters where they can take down the large transmission grids, bring up some micro units to serve people in those spaces. We were just working with a client not too long ago that's putting up some additional Home Depots, and they're talking about putting generation on site so that it can be 100% reliable and essentially off the grid. And social awareness. I think this is something, especially in the current state, that we have to be talking about. We've generally seen this change from a renewable and the energy transition occurring primarily because of mandates, both on the federal, state, or incentive level. So that's been the big driver in the past. However, when you start seeing, I don't know if you've seen the new Amazon commercials that have come out that say they want to be, I think it was 2030, 2035, 100% renewable or carbon free. And they state in those commercials, which is so interesting, they state that they don't know how they're going to get there, but their plan is to get there. So social awareness, especially with these large tech giants that are flooding the industry with these thoughts of the carbon, have actually started to move the needle a little bit further on the renewable side as well. And we'll see some large projects as well. Power generation projects, this was an interesting stat that we just found. Actually, this was just released by the American Public Power Association this week. But power generation projects financially backed by utilities ownership or utility contract accounted for half of the new capacity built in 2019 and 18. A lot of these are, one, social awareness and awareness of the utilities. Two, state and federal mandates, again, play into it. But we have seen an increase in a lot of the new generation projects that are being handled by the utilities or utility contracts, because, of course, that's where a lot of the energy is distributed from. Another big impact or another big state of the industry right now is grid resiliency. And this is just becoming more and more of a topic as our transmission systems grow larger, more complex, as the energy that needs to move across those transmission systems needs to happen at a greater pace. It's imperative for change to occur. We have a lot of transmission across the United States. One is the interconnections are concerning, and two, the state of the age of the infrastructure. And these aren't projects that we can just put a few dollars into and get back up. These are billions and billions of dollars in infrastructure that needs to occur over the next 10 years. We have renewables that we see still sitting down in areas that don't have the transmission capacity to get those renewables to the end source where it needs to be. So where those renewables are sited, how that infrastructure, that transmission can come into play, it can play a significant role, but it also can hamper. It can also tax these transmission grids to a degree that potentially could cause interruption and problems in the future. But where we're seeing from these transmission grids, and we were just on a call yesterday with a couple of senators' offices in D.C., where we see a major or potential barrier is collaboration, because you've got to collaborate across the country between the ISOs to grid operators to distribution units to generation. And there's a lot of differing opinions about how that should work across the country. It still is heavily mandated at state level in some regard, and not every state regulator is going to have the same agreement on how these grids need to move forward into the future. So there will be an increased collaboration. We've seen an increase of associations that are particularly looking at these issues. And it's quite interesting to watch these associations, because who they're bringing to the table is interesting. It's the collaboration between these large utilities or any utilities, the regulators, the people that study it from the university side of the house. All of these types of individuals need to come together and are starting to collaborate to say, how can we make sure that this grid gets more resilient, that the power gets where it needs to be in an equitable fashion and an efficient fashion for our ratepayers at the end of the day. And making sure that we don't have the brownouts and blackouts that have tended to occur over the last several years. So I think this was the number one, and I completely agree with everybody on this, the impact of regulation. Who knows where it's going to go next? You know, the interesting thing about the power industry in the United States is still, even with the Federal Energy Regulatory Commission, it is still very state-based. So there's a lot of state mandates out there, a lot of state differences between the states and how interaction happens, how those interactions occur with the federal level. And quite honestly, regulators are often slow to change. Not always, but oftentimes are, because there's a lot of agreement that generally needs to be made on a very high level. We are concerned right now about rate setting, in the traditional environment for our utilities and distribution entities. Most of those rate setting looks to a positive to infrastructure. So the more money you put into capital, there's the larger rate of return for your investors. In the public utility side, that's not as large of a concern, but the traditional approach has been to own your own own your own. Make sure that you're putting assets in the ground. There's a real question as to whether that approach going forward is really going to help the state of the industry or what we need for a holistic approach. So does it really need to have that infrastructure, or can we start taking a look at our rate structures and incentivize utilities and others and regulators to say the more efficient we can use the operations of our company, the more efficient we can use both of our capital and our contracting base is what we should be measured on, not just how many dollars we can put into our own infrastructure. There's a lot of conversations that have coming up the pipe, or down the pipe, but there hasn't been a substantial amount of change. We're starting to see indications of that, but that will be something that could really speed the energy transition marketplace. There's a question on the stranded cost consideration. Who's going to pay for if we become more efficient, if we make different choices, if we put more renewable down, but we have that maybe an energy backup or a battery backup has the ability to make it more of a baseload concept, what happens with some of our fossil fuels generation projects, and what happens with the stranded costs? Because at the end of the day, these were built for a specific purpose. If that revenue goes away, then how do we make sure that those stranded costs land in the right place? So that is something that is a very significant conversation that needs to happen in the future. And again, getting back to the grid reliability and resiliency, how do we ensure from a regulation standpoint that our grid is maintained, it's safe, it's at the right level, it's efficient and effective for the ratepayers as a whole. So I'm going to turn to, there's a couple of questions in here that I'm going to turn to first, and then I'm going to turn it back over to Jim to talk a little bit about his future state of the industry, and then I'll talk a little bit more about mine. So let me give me a moment to read the question. So the cost comparison between traditional and renewable energy, does the pricing factor in the cost of infrastructure and batteries, or is it separate? So this question gets into, the cost comparison between traditional and renewable energy. So in the past 10 years, and Jim, if you want to kick in, I know that you have information on this as well, but in the last 10 to 20 years, the traditional type of generation, so the fossil fuel type of generation and natural gas, has been traditionally much more cost effective than your renewables. Now that, again, as I mentioned, is changing, and it's changing because there's more companies that are manufacturing equipment. The equipment is just getting better and lasting longer. And so the pricing factor is equating out. Now, what's interesting about this is the why. Why did we build renewable energy before if it wasn't cost competitive? And will that incentive continue on? So the why of the matter in the country really started with the incentives that the federal government put down for renewable. They saw the need for these renewable projects. They knew they weren't cost competitive. And those federal incentives really led people or investors to start putting money into the marketplace for these generation projects. Now that they're becoming more cost competitive, and with energy batteries, increasing. So we haven't seen the full deployment of a battery storage. By full deployment, I mean they're not as cost competitive right now. We haven't seen what is going to happen in the future. The batteries will get better. They will be able to help these renewable resources that aren't firm resources into the future. So that will help the industry, but the fact that it's becoming more cost competitive is actually allowing the federal government to reduce some of the incentives as they become more cost competitive, and as the states essentially take hold on the carbon neutral and the renewable energy mandates and portfolios.
Hey, Julie, I'll weigh in on one of those cost questions that we saw. The cost of these wind farms, and I'm talking utility scale wind farms, we're seeing throughout from Texas to the upper Midwest. It's come down from around 50,000 a megawatt, or down into these days you can build them from I'd say 50,000. I apologize. I meant about 5 million, 4 to 5 million now in the 1.5 to 2 million range. Some of these new wind farms, which is that quite yet competitive with natural gas turbines? Not quite. I mean, you're still talking for a combined cycle gas turbine, from $1 million to $1.5 million. So just in the past 5 or 6 years, wind generation is almost the same cost now as combined cycle gas turbine, but you get something that the combined cycle gas turbines don't, and that's your energy source is free.
Yeah, perfect. And Jim, another one came across talking about how much as alternative energy sources continue to be dependent on federal and state subsidies. And, it's interesting with that because quite a few of the subsidies have gone away. There's still some production tax credits to the end of the year and potentially pushed outside of this year. But I think the answer to that question is we're seeing far less being dependent. I mean, some of the older projects that went in when the dependency was there, yes, but from a new project standpoint, I think the real question to that is where and why is this energy being put down? So, when you look at certain states, California, for example, that has very, very significant renewable energy mandates and carbon neutral mandates, they have to have certain production of these renewables. And in that, that state's going to pay a premium for your alternative energy sources because of those mandates, because the need is rising at a state and regulator level. So I don't mean to say it depends, but it does depend. When you don't have that kind of market demand or that demand on the regulation side, then some of these do need the subsidies or potentially the state subsidies to be cost effective. However, I think the social awareness continues to change and the transition will continue to happen. And I would expect that the feds would want this, or the goal of these is to get the technology to a place where it is cost competitive so that the federal mandates can stop or the incentives can stop, and that these become just projects that have their own competitive advantage as being one, renewable, and just two cost competitive. Would you say anything else to that, Jim?
No, Julie, I think you hit it spot on.
Perfect. So I'm going to move this to our future state, Jim. Oh, no, I'm not. I'm just joking. We're going to talk to another polling question. Amy, you want to take this one away?
Yeah, thank you. So our last polling question is, what do you see as the most significant area of opportunity for the energy industry in the next 10 to 20 years? And your options are A, electric vehicle infrastructure, B, carbon capture, C, renewable energy, D, grid optimization, E, autonomous operation and AI in oil and gas. And once you have completed all CPE requirements, you will be able to download a PDF of your certificate in the CPE progress window. And we will let a few more people respond here. Okay, here are the results.
Perfect. So what we're starting to call this is our kind of keyword in the energy when we're working in our energy space is the energy transition. And the real question in my mind, and Jim, you can kick in on this one, but the real question in my mind is the speed. I don't think that there's any question that this ball has started to roll downhill, that there is an energy transition that is occurring worldwide. And that energy transition is important. Now, let's back up a step and say that all forms of energy are important because you can't just take one fundamental piece of that away and suddenly overnight. So all of them are important, but the transition and how we supply it is changing across the world and definitely in this country. And the speed of which that will happen is probably the biggest question and biggest key indicator. Regulation will have a lot to say about that. Politics are going to have a lot to say about that. Administrations can have a say in the speed of that transition. But we definitely do see the ball rolling downhill as far as there is an energy transition that is happening across the U.S. and the renewable energy and somewhat carbon capture as well is our key focuses of the future and the transition. So moving into the future state, I'll start with some energy transition, and Jim, you can give your final thoughts. But when we look at electrification again, we are not seeing a decrease whatsoever in electricity needs across the United States. We see an increase in that. The question is how, and how are we getting those? How do we make sure the base load and the grid reliability are there? We've seen increase with the electrical vehicle mandates. I'm sure most of you have seen the news out of California that said that they will stop selling fuel vehicles in the future. I think it was 2030, I believe, maybe 2025. I can't remember off the top of my head right now. But if that happens, there's got to be a pretty significant amount of infrastructure in place in order for that to occur. Manufacturing and industrial continue to grow, sectors that continue to grow in their need for electricity. Even with some of these tech giants, when you start seeing the Amazons and you start seeing the Facebooks and the Googles, all of their needs are electric in nature. So they're going to need large data farms, large facilities. They're going to have to power their planes in a way to move across the country. So how does that happen? In our energy transition thought process too, I think the thing that will over the next 5 years is grid infrastructure. I mean, it is something that is at the top of a lot of individuals' heads, and the question is, how does all the different facets of the energy business take this into consideration and help this to move forward? The infrastructure is going to take some major investments, and there might be some new technologies that come out that help us out in that area. So again, grid reliability, the influx of the intermittent renewable energy sources, how is that whole game going to continue to be played? We need to get renewables online, but we need them online in a way that doesn't tax the grid or has the ability to get those renewables to the end source. There's a lot of new technology that's coming out from a grid modernization standpoint. I believe personally that there needs to be an overhaul of the regulatory rate recovery mechanism. But at that point too, again, these commissions are generally by state. So from your large interstate transmission projects that are ruled by FERC, that federal can come into play, but this is going to be taking a lot of considerations at the state level. And again, we don't know where the mandates are going to continue to go, but our full expectation that from a carbon-free, carbon-neutral, and a renewable energy mandate, those will just continue to rise into the future. Jim, do you want to give some parting thoughts on future state of oil and gas?
Yeah, thank you, Julie. I guess top of mind in Texas, Colorado, and a few other states is what's oil price going to be, and obviously I don't know, and everybody has a completely different outlook. I believe, just remember the benchmark. Prior to the pandemic, the world consumed right at 100 million barrels a day of crude oil to satisfy the refined product demand. And right now, this year, EIA, I think, says 90, maybe 92 million barrels for 2020 is where we're going to end up globally. OPEC has a little starker version of it. They think it's going to be somewhat less than 90, I believe. And, most of the big traders from Mercury and Trafigura, Gunvor, they're looking for oil in 2021 to be in, low mid $40. And I don't think, OPEC's planning is probably even a little more conservative than that. So I think the question that everyone has on oil prices is, will we get back? When will we claw back to that $9,900 million or barrel global consumption rate? And, personally, just the things I look at, which, decline on our major basins, OPEC's real supply, which is much more revealing now that Aramco is public. Peak oil could be somewhere 2026, 28, but it could be a while before we could claw back to that, and perhaps 24 months to where supply is trying to catch up with demand, I'll say, would give some headroom to oil prices. For gas, like I said, I'm very bullish on natural gas in the U.S. I think there's good headroom in that. It's more easily measured. Supply, demand, we obviously can't predict very cold winters yet, but there was some approximation. And, you know, midstream, downstream, it's going to follow suit. You know, gathering gas right now is not a great business. Gathering crude still can be a good business, as long as, you know, on the gas side, if you don't have minimum daily requirements or thresholds with your gatherer and you're selling natural gas, you're in pretty good shape. And certainly hedging plays an important factor in that. So, you know, as far as future state, you know, we may have to live with $40 oil for some time, and companies that are able to survive this, there will be good times ahead, but, you know, certainly it's not going to be in the next 2 months. So I guess that's, you know, all I could add on that, Julie.
Perfect. Well, we appreciate everybody joining in with us today. It is now 11:01, so we're a minute past. Amy, I'm going to turn it back to you, but have a great day.
All right, thank you. And thank you, Julie and Jim, for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download. A copy will be emailed within 3 weeks should you have difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete the survey, as your feedback is very important. Thank you for joining us. We hope you'll join us again next time.